So the Forex markets, I know you've heard about it, so let me explain it. The Forex market is where you exchange one country's currency into another country's currency. So the exchange rate price between two countries' currencies is always fluctuating based on which currency in a currency pair is in more demand than the other country's currency. So let's take an example, the euro against the US dollar. So every day the euro USD exchange rate is fluctuating, and during the day the euro may go up in value against the dollar, and the dollar may go up in value against the euro. And this is because the overall flow of money going from the US dollar into the euro, or the euro into the US dollar, is meaning one country's currency is being bought more than the other country's currency. Now, the fundamental reason why one country's currency is going up in value against the other country's currency is because of interest rates. Interest rates drive the demand for a country's currency. So if a country's central bank was to raise interest rates like in the United States, this could cause investors in Europe to sell euros into US dollars and park their money in US government bonds, or they can just earn free interest if they hold the currency. So what we need to understand about interest rates in an exchange rate is that whatever country has a higher interest rate is going to attract money into that country's currency, so investors can invest in government bonds in that country to earn free interest. And this is because interest rates equals free money for investors. So let's take the United States and Europe. If interest rates in the United States are 5% and interest rates in Europe are at 1%, then investors in Europe are going to sell their euros to buy US dollars and park their money in US government bonds to earn free interest. They can also earn free interest if they hold the currency. This is known as the overnight carry trade. So this is what can cause the euro to lose value against the US dollar if higher interest rates in America make the US dollar more attractive. On the flip side, if Europe was to then start to raise interest rates above America's interest rate, then money would come out of the United States and into Europe to go into European government bonds and to earn free interest when holding the euro. So the key to trading the currency markets is understanding whose country has the highest interest rates, and more importantly, what is the market's expectations for where interest rates are going next, because that's going to drive the value of currencies.